China has been systematically decreasing, I should say, its holdings of U.S. Treasuries. In July, the latest data available, Beijing's foreign exchange reserves fell to $730 billion, which is $26 billion less than the month prior to that in June. According to Chinese financial data provider Wind, the July figure was the lowest since January of 2009, and on top of that, it is 45% lower than the record high of $1.3 trillion recorded in November of 2013. The reduction in U.S. Treasury holdings in the PRC's portfolio comes amid growing warnings from Chinese economists about the weaponization of the U.S. dollar against the backdrop of rising tensions between the two superpowers, as well as persistent concerns over the sustainability of U.S. government debt. It is not yet clear what exactly the People's Bank of China is choosing instead of the dollar, but we do know that China is actively buying gold, further reducing its dependence not only on the dollar but also on fiat currencies in general. Reducing the share of U.S. Treasuries decreases China's dependence on American monetary policy, and it lowers the risk of asset freeze, as happened with Russia's reserves back in 2022. Increasing investments in euros and European bonds seems reasonable too. The EU remains China's largest trading partner, and exports to Europe are growing despite Brussels' efforts. At the same time, the risk of financial sanctions from Europe is significantly lower than from the United States. The same goes for the British pound. Despite Brexit, the UK remains a key partner for China in finance and in technology. As for the Swiss franc, it typically retains its value during most geopolitical crises due to its relative insulation from US and EU political influence. So these are unfavorable developments, of course, for the United States.